Good morning, ladies and gentlemen,
Good morning.
and a special welcome to our new MPC members who are with us for this press conference for the first time. And as well as mentioned, we'll introduce them to you. But maybe the point to do now is to introduce them, right? And I think the first person to, I need to just be sure I have all the specific facts. Thank you. Thank you very much. So the first person to introduce is Dr. Margaret Njoroge. Please, you could say hello. And she has served in various roles. She's not a stranger to the central bank by any means, and definitely not a stranger to the various policy making and other things, statistics and so forth. But in any event, her details will be sent out shortly. The second person to introduce is Mr. Humphrey Muga, who is also not unknown to any of you because he's a lecturer in the School of Business and Economics at African International University. He's also a former staff member of the Central Bank years ago, but there he is, still active. And then the third person is Professor Jane Kabubo Mariara, who also is not a stranger to the central bank and indeed other matters around here in terms of policy making. She's a long-serving professor at the University of Nairobi, Economics Department, and is the executive director of the Partnership for Economic Policy. So welcome again. The fourth member to introduce is Dr. Benson Akongo Ateng, who also has served at various roles at the World Bank and is currently the chairman of the Department of Economics and Development Studies at Technical University of Nairobi. So he has the shortest commute because all he has to do is to cross the road. And there's a bridge between us. So I think he's in very good shape. In any event, so welcome again, and I'm sure there'll be many more moments to interact at a later point. So moving on to the business of the day. You don't mind, I'll move it over here, you can hear me. So moving on to the business of the day, we just had the MPC meeting yesterday, and you already saw the press release that we issued last night. But I wanted to cover some specific items in rather quite briskly because there are many specific points that we may want to flag. So I hope you bear with me if I move a bit fast in some of the areas. But there are also many of them are things that we have discussed and plowed before. So I think it will be appropriate. So the first point to make relates to inflation. And the inflation outlook remains well anchored, but there are some lingering concerns about the fuel and energy prices. So in August, inflation was at 4%, as you know, but fuel inflation actually was at 14.2%. So you can see somehow 14.2 in the basket of energy and fuel, rather, and other aspects or other parts of the basket, like food, inflation on that was actually much more moderate. Actually, for food, inflation is at the lowest since May of 2002. It's actually minus 0.6. So prices on average are falling, food prices. And we can expect that to continue because of the favorable rains that we have been seeing and so forth. But we need to go back to the issue of fuel inflation. Several factors driving this. First, the decisions of the Energy Regulatory Commission, and this is adjusting the price of electricity. That was done in August and earlier. The question, as you recall, was earlier in the year we had a lot of rain, But somehow the price, and therefore hydro power, meaning hydro-generated electricity, was more available, and therefore we would have expected the price of electricity, meaning your bill, to lessen. But as happened, that did not happen. So, and we understand that the Energy Regulatory Commission adjusted prices to accommodate for some specific payments, meaning repayments, loan repayments that were being done. And we expect that will come down, meaning those payments have now been completed, and therefore the price will then be more, or will be lowered appropriately going forward. But that notwithstanding, there's also the issue of charcoal. We know that the charcoal prices increased dramatically some time ago, and this relates to the ban on logging and things like that. But what in the end happened was a substantial increase in charcoal prices, and that you expect to remain because that ban still remains in place. The other element which also was picked up in the numbers is the price of the global price of oil, right? That is rising, as we all know. And we were expecting that would rise to about, 71, the number I remember is $71 per barrel. But it turns out that actually the prices have already breached that level, and we don't know, nobody knows where these are going, but you can imagine what that relates to. It's all the, let's say, the geopolitics, particularly around Iran and those other Persian Gulf countries. So there are concerns there, but we accept those prices and adjust appropriately. So concerns from those three, and those three elements obviously were there in the numbers that I quoted for August, and will continue to be there. But then there's another element that came in, which is the VAT on petroleum products. You do remember the discussion that took place in our country, the robust discourse that took place with regard to the taxing, the VAT, putting a VAT, value-added tax on petroleum products. And yes, in September, as it turns out, there was the VAT was placed at 18%. Sorry, 16%. And actually, when the survey of prices was taken in September, meaning this month, the higher prices were generally in place. So you could expect that the prices or the CPI number, the CPI inflation number that we will see in a few weeks, that will be published in a few weeks, would be unusually high or surprisingly high, if you want to put it that way, because the survey was taken during the second and third week, during which most of that time the higher prices were in place. But the question is, okay, now we know it is at 8%. What is the impact on inflation going forward? And we've done our calculation, and the MPC deliberated on this as well. And there are two elements I would want to point at. First, you have the first round effects, which is a direct transmission of the price in the CPI of whatever petroleum products that you are consuming. Diesel, kerosene, whatever else it is. And that first round effect, we calculated at about 0.4 percentage points. So you can say that now inflation last month was at 4%. So all else held constant. This is a typical economist statement. Holding everything else constant, and only having the 8%, if you put in 8% VAT, then you'd expect that the measured CPI would be something like 4.4, so northwards of 4.4. Now, there's then the second round effect, which we have calculated, and this is once the price of fuel goes up, there are other prices that will also go up, for instance, transport. And actually, we did check and looked at transport prices, and some lines, transport lines, had already adjusted, maybe expecting the higher prices, the higher VAT to remain in place. But the point is that they had already adjusted. And so the second round effects, meaning adjustments because of the initial effect of the increase in prices, had already begun to take place. And this will generally take a few months to seep through the system. So you think of transportation, but you also think about, for instance, the price of transporting goods. Now, the transportation that we think a lot about is obviously, matatus, buses, and things like that. And we looked at some of those lines, and as I explained. But you'll have other things. You could think of transporters, charging a bit because their margins are being squeezed and so forth. So we calculated the indirect effect. And this, once it seeps through the system, we expect it to be somewhere in the order of 0.6 percentage points. Now, these are just estimates from our model, okay? So on the whole, you'd expect, adding the first round and second round effect, you'd have something in the order of 1 percentage point in terms of impact on inflation because of the VAT. I'm sorry for belaboring this, but I want to make the point that even if this full impact goes through, we will still remain with, unless there are other things to add, all things held constant, we will remain within the target band. That is the important point to make. Now, that doesn't mean we'll do nothing about it, but I think the point here is that it is important that to appreciate, as the committee did, that inflation will remain within the target band, despite, or rather, even putting in place, or with the effect of this VAT and the concomitant changes that we're talking about. Nevertheless, the reaction of the MPC in terms of such a move, the policy reaction is generally to accommodate the first round effect and then to counter, to resist the second round effect. So I think it is important to appreciate that. So MPC will not jump to completely counter the first round effect. It needs to allow that first round effect to go through, meaning inflation prices to go up in terms of all the other, as due to the VAT. But the second round effect, that's when, that's what the MPC's policy would really try to counter, resist that. So bottom line, I've mentioned, September, in terms of specific points, September inflation will generally be higher, but within the margin, as I talked about. We expect that number will be announced or published sometime on Friday. We don't know it, just like you. We receive it from KNBS, and we'll wait for that in a few days. I talked about the policy approach to it, which is allowing the first round effects to go through, but the second round effect or knock-on effect, resisting that. Thirdly, food inflation will continue to fall, given the good weather, and I made this point before. Energy, electricity prices, this we expect to be sort of on the downward trend for other reasons as well. In particular, we understand that the Takwel wind farm, I think it is called, and also the Garissa solar farm were to be commissioned sometime this month. So we are at the end of the month. I am not sure if they've been commissioned or not, but that notwithstanding, it'll be commissioned soon. And that will add something in the order of 360 megawatts to our generating capacity, which obviously is cheaper, cleaner, renewable in that sense. And you'd expect that will continue to add stability in terms of supply, but also cheaper in terms of generation cost. Then finally, there is, or two other points, the impact of new taxes. There are other new taxes that were announced in the finance bill, which now has become the law. So that's the Finance Act. And also to mention that the non-food, non-fuel inflation will continue to remain below 5%. So we don't see significant pressures, demand pressures going forward. That's what I wanted to say in terms of inflation. Switching quickly towards growth outlook, the overall performance remains strong, resilient, and indeed a very favorable outlook, or rather present a favorable outlook for 2018. Now, if you recall, the first quarter of 2018, we had reported a growth outcome of 5.7%. And so that we discussed quite some time ago. We analyzed it and so forth. We've looked at the leading indicators, and meaning you look at some specific, let's say, data, and that you expect correlate with the performance of the economy in particular sectors and so forth. And these are showing a strengthening of economic activity in agriculture, services, industry, and part of this we understand, right? A lot of it we understand actually. Favorable weather, for instance, has really helped agriculture and so forth. And now we are estimating growth in 2018 Q2, so the second quarter of 2018. We expect that to continue to show a strong performance. Now, if you really want to know what is the number for our model, what the model is generating, we are projecting a growth rate of 6.1%, but it could be higher, 6.1% or higher for Q2 2018. Now, those numbers will be published, or the concomitant numbers will be published, I guess, later this week as well. So at the same time, Friday, as the CPI. But I'm just making the point that when the MPC met yesterday, they obviously did not have the benefit of the outcome because we don't have that. But the models that were present, the outcome, or let's say the output of the models that our staff in research have been presented continue to show that Q2 will be favorable in terms of will have a strong outcome, as I suggested. Okay, now at the same time, the outcome for 2018, we continue to project a relatively strong outcome. I think last time we talked about 6.2%, and that's the number we quoted to you last time, and we continue to see that. So we haven't adjusted, if you may, our forecast for 2018. We still see a good, strong outcome in 2018, all things considered. By the way, the sentiments in terms of investors and consumers, as you know, we get this in the context of the MPC survey that we do. And as an aside, I would continue to encourage you to look at those published, let's say, data that we published from the MPC survey. We are doing it now every time we do this survey. You had asked about it last time, and it's I think it's for you to study it. We do not want to write articles about it. You write the articles. The data is yours. The data is ours. We are putting it out. And I think it will allow a proper discourse about economic matters. That said, the outcome, or rather the responses that we got are that sentiments remain strong, but they are somewhat dented or dampened by the concerns about the impact of the VAT on petroleum products. So remember, we did this MPC survey when the discussion about the VAT was at its peak, right? That's when there was all this discussion, and you are probably in the middle of that whole discussion. So given the context, it's not surprising that there were concerns, or rather the sentiments were somewhat dampened by that. But that notwithstanding, the outcomes, or rather the sentiments, remain quite strong. I want to talk a bit now about the third element, which is an external sector. The current account deficit is narrowing, and the foreign exchange market remains balanced. I think we talked about this last time, and we keep talking about this, so it isn't just once. The point is that this is happening on the back of strengthening agricultural exports, tea and horticulture, and others. I love avocados, so I generally follow avocados. So anyway, those are all part of horticultures, by the way. Lower imports on food and SGI, on food, for instance. You remember that a year ago, we had quite a bit of imports related to food imports. And also the SGR, they have accelerated some of the imports related to SGR. So going forward, there'll be less there'll be less imports relatively going forward. And as you know, the project is going ahead at a pretty fast clip. And then remittances. By the way, remittances to July. So the first 7 months of 2018 relative to the first 7 months of 2017. Remittances are 41% higher. 41%. So something is happening there. And I think we've made the point that there are several reasons. The first, of course, is that there are three reasons that we've pointed out. First is that our diaspora still are working, meaning that the economies that they are working in particular the US economy and the UK economies, they are doing well. I mean, it's another thing if they were jobless and things like that. I think you understand the connection there. Secondly, is that they have very favorable sentiments, meaning the diaspora have very favorable sentiments, just like those people that we sampled in our MPC survey. So they have very favorable sentiments with regard to the Kenyan economy. So they want to invest here. Obviously, a lot of the diaspora invest not only for themselves, but for their immediate family and other things like that. And investment here doesn't just mean securities, in government securities. It means other things as well. Housing in particular, investing in others, capital, human capital, and so forth. We understand all that. And the third element, which is also important, which underscores the stability of this increase, is that the various institutions, in particular banks, have introduced new instruments that are aimed to simplify the transfer of the remittances, and also to reduce the cost and also reduce the time. So they have introduced much better instruments that are targeted to do this, and this I think has been quite useful. There is actually, at times, some of you have made the point that the tax amnesty has had an impact, and here is where we'll probably differ. We haven't seen that level. And we track a lot of the flows that come in, and we haven't seen that sort of level of inflows that we could call tax amnesty, but the jury's still out on that. Fine. So that's a backdrop in terms of the external sector. What is the outcome? The outcome is that the current account deficit narrowed to July the 12 months to July, it narrowed to 5.3% of GDP, and compared to 6.7% of GDP in July last year. And we expect the current account deficit, therefore, for 2018 to narrow to 5.4% of GDP compared to 6.7% in 2017. So again, shows a narrowing of the current account, and also concomitant, at the same time, you have had a stability. You've had stability in the flows, that's the outflows and inflows in the FX market. Hence, the relative stability that you've been seeing in that market. That's what I want to say just now about this, and we'll move on to other points. Banking sector, again, I'll be a bit unorthodox and not follow what I did before. So without a doubt, the most significant recent news related to the banking sector is about the completion of the Chase Bank in receivership and SBM Bank transaction on August 17th. That's the most significant piece of news in the financial sector in a long time. And it related to, as you know, the carving out of a portion of assets and liabilities, and that is, it included something in the order of 54 billion of deposits, which now from the Chase Bank in receivership, and which now have been given, or rather depositors have been given access to these deposits under or in SBM. Those are the moratorium deposits. And again, you know the details, we've talked about it before, that 75% of the deposits that were in 75% of the deposits in Chase Bank in receivership were made available in the in SBM for depositors. The interesting thing, which was, I guess is not interesting now looking back, is that depositors not just appreciated it. I mean, this was a significant news for them. And they were obviously very, very favorable about this. They held this very favorably. It's true, at times one wonders if, is the glass, or the glass 99% full or 1% empty? I don't know. It depends who you ask. There are those that will always see the 1% empty. And I think the facts are there for them to see. And they can talk to the depositors, and you can be sure that the depositors appreciated this, despite the wait that they had to wait, and they understand why they had to wait. Now, that doesn't mean that we are at the tail end of that. Of course not. Further work is needed, and we need to engage the creditors now that the dust has settled on this transaction, with the objective of maximizing the return to all stakeholders. So we still need to do some work here. Now, that said, maybe for completeness, I say one word about Imperial Bank in receivership. The situation there, as I mentioned before, is that yes, we did get a proposal from Kenya KCB Bank, and we have been working with them to improve that proposal, upon which we will get, or the steps are to get an offer, an improved offer that we will then look at, decide, explain to the depositors, and then execute on it on a particular way. It follows exactly the let's say the design that we saw, that we followed in the case of Chase Bank in receivership. So you would understand it. And I hope at that point we would also not say that the glass is 1% empty. But anyway, let's leave that. Okay. We will obviously meet depositors at various points, and when we have appropriate information, we've also committed to communicating with them appropriately. And I think the point here is not to just have a meeting that doesn't have any information, but to provide information with them. That's all I wanted to say about the banking sector specifically in terms of these developments. But just to complete the narrative, private sector credit growth is at 4.3%. I think that was mentioned in the press release. And we expect this to strengthen. We hope that this will strengthen as we go forward, say to about 7% later in the year. And NPLs, this is a good point. NPLs, non-performing loans. The ratio to gross loans was 12% in June. And in terms of NPLs, in nominal value of NPLs, meaning KES, Kenya shilling equivalent, Kenya shilling amounts of the non-performing loans, they grew by 26 billion, right, from June, in nominal terms. Half of which relates to the Chase Banking Receivership SBM transaction. As you can imagine, there were specific loans there that were non-performing, and so they moved over. And of course, the Chase SBM will endeavor to make this whole, to resuscitate these loans in particular ways. But I just want to mention that because that increase, half of that increase that I mentioned, relating to this transaction, is actually, it's in the numbers, but we need to understand it. It does not show, it does not indicate a negative concern in terms of the banking sector or economic developments in our, and things like that. That understood and controlling for the transaction, NPLs in August, that is excluding that transaction, NPLs in August would be or were at 12.1% compared to 12.0% in June. Last time we spent some time talking about where these are concentrated and things like that, but in the interest of time, I'll move on to other things. Now, when we met in January 2018, we talked about a confluence of positive factors. Confluence of positive factors that would push our economy. At that point, we talked of very favorable external factors. Remember, we talked of the global growth, and we used terms like it's been a long time since the global economy was growing at the projected rates. We also used other let's say, devices, but let's leave that. Also, secondly, we were seeing very favorable domestic factors. We talked about the sentiments and all the other things that we talked about then and now. But we then also talked about what I termed as a perfect storm, meaning if we had other factors, the other factors that if they came into the mix, we would have a confluence which in itself would be a perfect storm, which would propel the economy into, let's say, a new echelon level, a new level. And at that point, we talked about two factors. Well, actually, there were other factors, but the two factors that were significant then and I want to discuss today relate to fiscal consolidation and removal of interest rate caps. At that point, we flagged and said that if these things were to work to strengthen the economy, there would be a quantum change in the way the economy behaved. And that is what I call the perfect storm. Now, where are we with those two? On fiscal budget, on the fiscal consolidation issue, I think last year, last fiscal year, 17-18, financial year 17-18, the outcome of the deficit was 6.9%. These are numbers that relate to the current estimates of GDP and things like that. If there are new GDP numbers, then these numbers will change, but this is what we have today. So 6.9%. And this is against a target of 7.2% of GDP. So they came within in terms of deficit. Now that is important, but I think it's also important to note that the composition, expenditure and revenue is something that Treasury is working on, because that was not completely appropriate from their perspective, and they want to strengthen the various elements, meaning the revenues and also the expenditures, to come up with an appropriate deficit, but appropriately built up, as it were. I don't want to say too much there, but I think there has already been concerns about that, discussions about that. The deficit that they are projecting, or they expect in 2018-19, so this fiscal year, the year that just started in July, they have a deficit, or they're targeting a deficit of 5.7% of GDP. 5.7% of GDP. So, if indeed this is carried out correctly, it will lead to a consolidation, fiscal consolidation. And I think at that point, we could see that there's a rebalancing of fiscal and monetary policy. Because I think at one point I did explain that there is a real need to rebalance fiscal and monetary policy. Meaning monetary policy was very tight because partly to compensate for the rather loose fiscal stance, or stance of fiscal policies, right? And the example I gave then is, having two drivers, or rather the old cars where you had the trainer on one side and the student on the other. One has the foot flat on the accelerator pedal, and the other one has it on the brake. So we need to adjust and figure out who's driving, and not so much driving, but rebalancing this. So I think that my point here is that it is important that the outcome is consistent with the target, the 5.7. The target is welcome, and we hope that this will allow us going forward to, in a sense, loosen or provide room for loosening of monetary policy. So that's what I want to say about that specific element of. The second one was interest rate caps. This, I think you all know what happened in the end. Obviously, we did propose removal of these caps, and the proposal was not on what I'll call, philosophical considerations. We've dealt with the theory, we've dealt with the philosophy, we've dealt with all those things before. This is not a time for theory, it's a time for action. It's a time for figuring out what is the impact on the economy. And we've explained in quite elaborately the impact of these interest rate caps, and I'm sure you've seen it yourselves. We continue to insist that the interest rate caps are struggling the economy. I would want to say they are strangling the economy. And there is an answer to the question that you probably will ask me, which is, so Governor, you are talking of all this very buoyant economy, right? That's what I talked about before. But we don't see down in the trenches what's going on. The issue, in a sense, relates to this, that actually the smaller the enterprises, the small enterprises and other people that are probably lower in terms of income, income per capita and things like that, they are the ones that are hit the hardest by this interest rate cap. And so in effect, yes, we are strangling the economy by, let's say, putting out of the system those that need this support the most. So what is our point here? We cannot give up. We'll continue to have those cups of tea with the various policymakers. We'll continue to explain to them again and again, and they will understand. We need to present the data. Again, we are data-driven in our decisions, so we'll continue this. So we are not giving up. We'll pick it up again and continue. So those are the points I wanted to make on those issues. But there are several other points I wanted to raise. I wanted to talk a bit about a question that some of you have raised, which is, do we have adequate reserves? Does the country have adequate reserves? Foreign exchange reserves we are talking here. And I think this discussion came up in the context of the ending of the IMF program back a couple of weeks ago now. In terms of the specifics with the IMF program, you know that was approved March 14th, 2016. And actually you had two arrangements. Okay, so this is jargon for some of us, but I'll throw the jargon out there. So you had a standby arrangement and also the SCF, so standby credit facility. They are different in particular ways. We can have that discussion offline. But cumulatively taken together, they allowed us, there was resources of something like 1.1 billion SDRs. I'll talk in SDRs. Okay, so 1064 billion SDRs. And this program, and therefore these two arrangements were precautionary. So, and in a sense, it was an insurance policy for us. So you want to have insurance for extreme events. So you'll only go and claim, put in your claim when the bad event takes place. So that's the concept of precautionary. Both of them were precautionary. So it wasn't one and the other, it is both of them. Okay. Now, what were we insuring against? We are insuring against adverse external conditions. Yes, true, if you look at the various discussions, and there are also domestic shocks. But domestic shocks generally, like drought and things like that, those we do have a pretty clear approach. And remember, we also had a drought in 2017. And we did not draw on the precautionary arrangement then. So the point I'm making is the biggest shocks that we were really trying to cover ourselves against were external. So the external shocks, global jitters in the global financial markets, for instance, significant changes. Remember, we are still coming out of the global financial crisis. So, and things in the order of Brexit, for instance, things in the order of interest rate increases in the advanced economies, and other such events. Now we have the trade wars and things. So those are things that may hit us negatively and substantially. Hence the need to insure against them, and this was the point then. Now, of course, what has happened since then is we've had a lot of shocks. We just now talked about the Brexit, which was a huge shock, if you remember. But actually, we were able to ride through it. We didn't request for a disbursement, or technically, you call it a drawdown, on your precautionary arrangement. We did not request. And there has been other things. Interest rates have gone up in the advanced economies. Again, this was shock. And even more recently, a few weeks ago, we did have this EMs, emerging markets, coming under pressure. And we were able to ride those shocks. And we've explained the reason for our resilience. And some time ago, we were quite explicit in terms of explaining the sources of our resilience, of the resilience of the Kenyan economy. And we explained this. I'm not going to do it today. But I just want to make the point that the shocks did happen. We were not affected significantly because of our resilience, and we moved on in a sense of those shocks abated, or in a sense receded, and the economy continued to chug along. So that's the general picture. Now, when you get a shock, what is the step-by-step approach here? I mean, how do you react to shocks? First, the term I would say is you react to shocks incrementally and proportionately. So you don't go from 0 to 100, right away. So it has to be incremental and proportionate to the shock. So several elements. First, the first line of defense is strong policy buffers. So a very strong macro framework. So if you look at our macro framework, it looks quite strong. And that is always, and it allows us room to maneuver. For instance, in monetary policy, we can tighten, we can accommodate. So I think the point here is that this is an important element. We don't go from just like anything else. You don't go to the end. You begin incrementally and proportionately. That is important. That's always the first line of defense. The second line is our own resources. In this case, our own FX holdings, for instance, if you're thinking of a shock from outside. Again, so it is, and we'll come back to that in terms of adequacy. The third is any precautionary lines that we have, right? And that includes in that case, the IMF the IMF precautionary lines were appropriate for that. And then, of course, in extremis, or as let's say the shock becomes bigger or is much stronger, then you have a lot of other options which we can discuss, but I think those you're very familiar with. I'm sorry for being a bit going through it in this way, but I think I wanted to explain it so clearly so that we can be on the same page. And if we make mistakes, then we know where we are making that mistake. Or if we have a discussion, then we know how we are approaching the discussion. So, bottom line, adequacy of results. How adequate are Kenya's results? And there are several measures. And I do recall back in 2017, we did have this discussion before. Again, it was, I think, in January of 2017. And we covered the issue of, do we have adequate results? And I talked then of various papers that discuss this issue and various metrics. There's no single metric. So I want to throw 3 metrics at you, which are some of the ones that we do. First is import cover, standard, and we have it there. There is only one little problem, which is the denominator, meaning imports, is not, there's no one way of measuring that. It's true, we know what imports are, but it is, imports, is it looking back, meaning the last year, or the last 3 years, or looking forward, which is imports, expected imports and things like that. So in any event, from our perspective, we need to make best endeavors to maintain reserves at no less than 4 months of imports. And this is as recorded in the last 3 years. So you could think of the last 36 months. And generally, that is now somewhere like 5.6. You see those numbers every week, 5.6. And if you look at even in terms of US dollars, it's actually peaked sometime in around April this year, and it has come down a little, but has remained above the 5.5 range and so forth. So that is, I can answer your phone, What is it? You ordered pizza? No cheese, please. Okay. So that indicator import cover shows that we have adequate reserves, because, as I say, at 4 months of imports, and we are way above, we are at 5.6. We are way above that. Also, in terms of, if you look at other ESC benchmarks, which the only point there is 4.5, we are above it, as I explained, we are 5.6. So in terms of import cover, that according to that metric, it's adequate. Another metric is the ratio of reserves to broad money. Broad money to you is the M3, and that remains appropriate as well. So a general threshold for this is typically at 20%. So you have reserves to cover 20%. And frankly, we are above that. We are 25, and at one point we were actually at 30, in the recent weeks. So 30%, 25%, way above the 20% threshold that we have had. By the way, in this metric, we have always been above 20%, going way back, several years back. And you need to go back in the knots to get to a time when we were below the 20%. But so that's another indicator, and it shows that we have adequate reserves. A third indicator, which we talked about last time, back in 2017, which is the ratio of reserves to short-term debt. So you have debt that is falling due in the next 12 months. That's what is defined as short-term. So what is falling due? Obviously, it may have been a long-term debt some time ago, but now it's due in the next 2 months, the next 6 months, the next 12 months. Now it's short-term. It's in the short-term. And again, the indicator here is that, or a threshold, is 100%. So you want to have your reserves at above 100% of short-term debt. Mind you, it means that if you didn't get a single dollar foreign exchange, you can still cover that, and you used all your reserves for only that purpose, then you can still cover it. That's the general thing. But of course, one knows that you'll have you'll actually accumulate reserves in other ways, through monetary policy sort of positions and things. But whatever it is, 100% is a good threshold. The point is, we are at 240%. 240%. So, ladies and gentlemen, I think the issue of adequacy of reserves, we can conclusively say that this is not a concern. We have adequate reserves in Kenya for the business we intend to do, and we will continue to maintain adequate reserves as needed. Then I have a couple of points. I'm sorry, now we are getting into some of the details that are not specific to this, but there's a concern that I read 2 articles recently, yesterday and the day before, and I was quite surprised how diametrically opposite they were. The one I'm talking about is a Bloomberg article yesterday that says Kenyan stocks are world's worst performers as interest cap bites. I do not want to deal with that, but I just want to make a couple of points. The points I'll make are the following. Reading the article, you realize that it's talking about what has happened over the since June of end June, so July, this quarter, and it's the world's worst performing stock market. I guess I only need to show one stock market that is performing worse than ours, and that'll be it. Just one, right? This is the problem of such positions, extreme positions. I don't need to show Turkey. Everybody would laugh when I said, well, what about Turkey? We don't compare ourselves with Turkey, do we? But anyway, the point is that if you only show one, you can always show Turkey, and that is an issue. But it isn't just Turkey. I don't want to continue along this line without making just a simple point, which is the facts do not align themselves with such a statement. And I'll just make specific points. If you look at, and we can talk about, for instance, South Africa, we can talk about Nigeria, we can talk about Ghana, we can talk about other African stock markets, not even going to sort of other EMs. But even closer home, why don't we talk about Tanzania and Uganda? And since June, the Kenyan stock market has weakened in terms of market capitalization and all by 14%. And the FX, taken in including the exchange movement, it still remains about 14.5. Tanzania has gone down by 9.4%, and including the FX movement. So if you are thinking of an investor, external investor, as the article suggests, then you have something like 8.8. So that is the reduction. And then you have Uganda, 14%. With the exchange rate adjustment, it has 15.7. So I hope I have at least shown one. We can talk about others. We can talk about even the period, so meaning since the year to date. Or for that matter, we can talk about the period, January to September. But I think the point I'm making is the facts and the headline do not align. I want to move into other things. The points I want to make aside from this, and by the way, I have a lot of charts here that we can actually discuss if you feel aggrieved by my statement. Or maybe I'll let loose some of the research people after you, but that's probably better. Then I want to say a couple of points before taking questions. The first is it relates to the investigations that have been ongoing with regard to the banks. And I think you recall that we put out a press release barely 2 weeks ago, September 12th, and explained what is it that we had come up with and what is it, how we were working with the banks, or what we had required the banks to do. And we explained why. The point is that they had until yesterday, Tuesday the 25th, all 5 banks were supposed to submit to us responses to the penalty notice. Remember, we assessed them on specific penalties, and they had to show cause for us to move on with the penalties. So that period, again, as I say, expired yesterday. And the other thing they needed to show, to submit by then, is a time-bound action plan that is approved by their respective boards. That is what we required them to do. Now, in terms of the next steps, I can confirm actually that as of yesterday, COB, all 5 banks had submitted what they had been required to do. That was submitted as of yesterday, all 5 banks. And what we now need to do is to review the responses and then levy the penalties as appropriate. We will in particular review the reasonableness of the action plans and immediately commence monitoring their implementation. We had already indicated that we will monitor the implementation of this action plan. Now, also, as we had indicated in that press release, is that we would investigate an additional set of banks as we go forward. We can also confirm that the CBK continues to support other investigative agencies, such as the Directorate of Criminal Investigation and the Office of the Director of Public Prosecution, in the findings and further investigations that they are conducting. Of course, CBK remains fully committed to ensuring the banking sector's legal and regulatory framework, including the AML-CFT framework, is aligned to best practices. We mentioned this last time, and we insist on it. We'll also continue to support the rule of law through enforcement of strict adherence to the applicable laws and regulations by the banking sector. Ladies and gentlemen, we could continue, but I think I've taken too much time. I can see Wallace already getting excited, so maybe we should stop now and take your questions. Thank you very much for your attention.
Good afternoon, Omar Mohammed from Reuters. I had a question about your comments with regards to the wage caps. To borrow a phrase, you said that they're struggling the economy. I was wondering if you could talk a little bit about specifics when it comes to what the CBK is doing to have those lifted. Thank you.
Thank you. Well, really the anniversary of the COVID collapse, so this will work. Is there a binding offer? We're going to see the near future, the interviews with the president. And then the other question is about there's been a bit of concern on the domestic borrowing in the bond market because we've seen a bit of underperformance. So is the CBK considering making the long-term bonds more attractive, probably amortizations or anything, just to value it to see if lenders can take a long-term bond? Thank you.
Yeah, Patrick, I should have say maybe two questions. First on Imperial Bank. The development on the Imperial Bank touching on the deputy CJ. Do you think in any way it may slow down the deal you have with KCB, given that you are anticipating that there will be an improvement in the offer? And number two is on the outlook of the credit, the growth in the private sector credit. We've seen a gradual increase, but on the other side, when you look at the numbers you released on the banking supervision, it points to a sector that has lost almost 1.3 million loan accounts in the last 2 years. Does this point to a sector where there are no new borrowers joining the bank, but rather just the obvious one? And probably people have numbers pointing to the average size of the loan at the moment.
So let's first take Omar's question on interest rate caps. What exactly are we doing? I think the first thing is we need to be clear what is it that we are proposing. Meaning, we need to appreciate where we are coming from. Why were the interest rates put in place? And in a sense, the interest rate caps were put in place largely because of concerns about how the banks were operating. I think that point needs to be emphasized. We've made that point several times. So in that sense, the interest rate caps, you may think of them in a sort of a most favorable scenario. You could think of them as a sort of a very blunt instrument that tries to resolve a problem which needs precision, So our view here is that let's work on resolving the underlying concerns, and then the interest rate caps will therefore no longer relevant. I hope you understand what I'm trying to get at. Blunt instrument always hurts everybody. But if you are precise and can deal with the problem, the cancer, deal with that, and then the rest of the body can continue moving along. I hope the analogy is clear. But obviously, I haven't answered what exactly we are doing. So what exactly are we doing? First and foremost is to explain to everybody the impact of interest rate cuts. That needs to be understood. It looks like an easy solution. And in a sense, you could have made this point before. And I'll be a bit aggressive. It's a bit like doing drugs. Don't do it. I hope you understand what I'm getting at. It looks like an easy steroids. It looks like an easy solution if you're a runner, right? There is a solution, performance-enhancing drugs. We have seen our athletes succumb to those problems, to those evils. That is the problem with them. And there's no other way of explaining it except in those sort of gross terms. If you talk to Eliud Kipchoge, what will he tell you? Train, do the hard thing, be disciplined. This is what he was telling us. And that's really what we need to do as an economy. Go back to these fundamentals. Go back to the correct way of doing banking, to the correct pricing of things and so forth. So it isn't just remove of caps that is the issue. It is how do we move forward in this sort of context. So what are we doing? I think the first thing is in terms of the banks themselves, we are encouraging them first to change the way they do business. First and foremost, in terms of their business models, strengthening their business models. We've explained that. We've also explained that they need to be they need to price loans according to risk. So risk-based pricing of loans. I've given this example of two people that have the same project, chicken farming. I know nothing about chicken farming. You know something about chicken farming. I should get a higher rate, because I'm more risk. There's more risk in me, right, in terms of my chicken farm. So, risk-based pricing. The other thing, of course, is providing information to consumers. Information not just about what the loan will be and all those other things, but providing full transparency on a lot of the information in terms of pricing and all aspects of it. Thirdly, or fourthly now, I forget, there are like 7 points, so I'm not sure where I am now. But in any event, next point is the point about ensuring that there is a credit reference. CRBs are actually effective. So from my perspective, if I have a bad track record, I should get a higher rate than anybody who has a better track record. Also customer-based, customer centricity, which is a big thing of banks, customer centricity. And we can talk a lot about this. And one element in all this that we had put on the table and has already been discussed with the banks, and we put it out actually on our website for comments from all of you, was also having a charter that explained how banks were going to deal with consumers in particular, in clear, transparent, with simple language. So in a sense, it is a package. It's not a one sort of lever that will do the job. So I think it is important to see this as a holistic approach to the problem. And that's the only way you'll have a change of culture and change of approach that will be beneficial to all of us. Now, that is on that side. Obviously, on the other side, it means I need to explain it to a lot of the let's say, the parliamentarians, politicians. And this I had explained in the context of having cups of tea. So I love tea. So I'll have a lot of tea with the politicians. And I've been doing that. I think you understand what that is about. There's a book, which I mentioned before, which is 3 Cups of Tea. You may want to look at it. So Omar, I hope that covers the issue. There was a question about Imperial Bank, 2 questions actually. Gunyunyu and also Patrick. So what's next? I explained what is next a moment ago, but just to repeat, last time we had a conversation with the depositors and others, and we did explain that we are working with KCB and KCB Bank was to provide us with a proposal that we were discussing them to improve it, right? That is what I explained last time. And just now I said that we will get the offer, we will review it, we will see whether it meets appropriate criteria for us. And the criteria, by the way, were published on our website and in the binding offer. So you can see what the criteria are there. But in a nutshell, it is really whether we think that this is a good offer for the depositors, or whether we can demonstrate that that is the case. So that's where we are. So we are in that sort of limbo, no man's land. And that's where we are, and we intend to bring it to completion. So I don't think the issue, you should be comfortable that there's no, that there's no lack of courage on our part. I hope you can put that to rest, Bunyunyo. You can quote me on that. He quotes me on other things, not on these things, so I don't know. But in terms of the second point which Patrick asked, the point I would make is we cannot comment on any case that is before the courts. That is not something that we are in a habit of doing, and obviously this and others, we cannot comment on them. But the point again is that everybody understands that the judicial processes will follow. This has nothing to do with the judicial process. It is clear what the offer was in terms of KCB. They are sort of, let's say, sketch of an offer. And as I had explained before, it is an offer that is consistent with what happened in Chase, meaning it's a carve-out of assets, of some assets and liabilities, and leaving everything else. That has nothing to do with things that may be, let's say, contested in the courts and things like that. I hope that clarifies. You had a question about domestic borrowing underperformance. I don't know. I mean, again, there's this danger of expanding from one observation, right? Look at last year and see how many times you had undersubscribed, or in your words, underperforming auctions. And you then compare it. You only have, actually, if you look at how much we've borrowed, or rather we've raised in the various auctions, to date, we are much further ahead. Last year was particularly hard, and we actually got to the final point, right? We hit the expected borrowing, net domestic borrowing that we were aiming at, to the button. So I think we shouldn't be too excited about, underperformance here, underperformance there. There are many reasons for underperformance, and some of which, as you know, we don't know the pockets of the investors. And at times they have other offers elsewhere. And maybe they are waiting for 2 months because they want to consolidate. We don't know. You cannot get into their head and understand that. But I think the point here is that we look at last year. And if indeed you think last year was kind of shabby, then let's have a conversation. But I think you're having looked at it, you'll see that actually it was a good outcome in many ways, under rather adverse conditions. You remember we had also the issue of 2 elections in the middle there somewhere, right? And you can imagine that was not favorable to investors. So I think the point is that there are many of these things that we need to look at. And I don't think the domestic, the underperformance in 1 or 2 auctions should be a cause for any concern. Then there was a question by Patrick on credit. I don't know. Actually, this tells me something else. I don't think I'm as concerned as you are about the number that you put out. I don't know if it was you who wrote that article. I mean, the number of loss of loan accounts and things like that. I don't know. Actually, for me, the big issue is is there a decrease in sort of number of active loans or loan accounts? That is, and have people moved from getting loans in the, going to banks in the brick and mortar world to mobile sort of space, the mobile phone space? Those are the issues that I think we need to look at and understand better. But there's no doubt about it. There's a shift that is taking place before us. And I think the shift is away from the brick and mortar, the standard ways of doing things. Maybe it would even be a shift away from the size of loans that we had before. I mean, you probably go in and ask for what, 1 million. Now maybe you're asking for the 50K when you need it, because you can get it there and then. I don't know. You understand what I'm getting at, Patrick? Those are the shifts that I think are probably taking place and we need to understand. Your question has reminded me of something else, which is we are putting out on our website a lot of information. And I hope you have already begun to see that. We made this commitment quite some time ago. I talked just now about the MPC survey. I talked also about the information that you got from this, but also other things, the credit officer survey, the quarterlies. There's a lot of information which we are putting out there for you and others to analyze and assess. And at the end of the day, our commitment has always been the same, which is we want to make decisions based on what the data tells us. And I hope that by putting the information out there, it will also improve the quality of our discourse. Other questions, please.
Thank you.
Good morning.
You need to stand up, please.
Good morning. My name is Njoroge from KTN News. My question is in regards to the VAT tax, which has increased to 20%. And we know that in recent years there's been an increased dependence on mobile money transfer and mobile banking in both consumers and businesses. So how much of an impact do you think that this is going to have on MSMEs and small businesses? Because as we know, MSMEs are a very, very crucial part of the economy.
I think you need excess tax on money transfers.
Sorry?
Is there excess tax on money transfers, not VAT?
VAT on, but from 12 to 20%.
What is the excess tax on money
Yes.
transfers?
Yes.
Not VAT.
Yes.
Additional budget. Alex?
Alex Macho, NTV. Regarding the 41% increase in remittances, I just want to know whether it's a figure that comes from the banking sector alone or whether it covers even other maybe MFIs or other institutions that are involved in helping the Kenyans in the diaspora to bring back the money, and then where you think possibly this money will be going towards as far as investments are concerned.
Thank you. I'm Victor from the Standards Group. Victor Mandala from the Standards Group. On Friday last week, SAP did farm foreign and domestic credit projects that are being positive. And it indicated that we have enough foreign reserves to cushion our shilling. But however, it said that the shilling is rather half naked without the guiding facility. Maybe, are you likely to sit with the Treasury CS to write a letter to IMF, maybe to make sure that the shilling is fully interested?
It's the first time in the Central Bank has organized a work
Yeah, my name is Kepa Njoroge with Fanaka TV, and my question is more of the same from what Victor has. You've mentioned that we have enough to cover our inputs for the next 4 months and spoke of the resilience in the Kenyan economy. It seems that we've been able to ride out the waves of Brexit, the emerging market, which was what Argentina and Turkey has been going through. And so my question is, certainly, a comment on just how important is it for us to get a new arrangement with the IMF, given that the external shocks that we are still witnessing them. One of course, is the price of crude oil, we've seen it around the $72 mark per barrel, and experts are seeing it going way into close to that $100 per barrel mark. And just to add on to the question, there is certainly, you talked about the naked shilling, and for me I use driving without insurance, and that necessarily doesn't mean that you'll cause an accident, but still just how important is the new arrangement with the IMF.
Councilman, I'm ready for the last one for this round.
My name is Kabuya from Ebro TV, and my question drives on the same note with Victor. I saw also that comment on the naked shilling. It was last week. My question is, based on the projections from the IMF facility, what are your projections toward the end of the year on the stability of the Kenyan shilling?
Let's begin with that question. So S&P makes this remark that Victor, you mentioned. I don't know about that. I already told you what our views are. I don't generally want to get into colorful language, right? At the end of the day, we are economists. At the end of the day, the question is, why are we holding reserves? And what are we doing in terms of the shilling, right? And here, I think I've told you enough about the reserves. Now, Keva, you have to appreciate this. The issue isn't, and I'm sorry I'm taking all three of you together, right? The issue isn't that we have enough reserves for the next 4 months. That's not the way it works. I have said that it is, 5.6 and so forth, but that is just an indicator, right? So, no, it doesn't work that way, because we are going to be getting reserves coming in. It's just an indicator. And we are not the ones that, this is based on economic arguments. This isn't a political stance, that we should have X or Y or whatever. I already pointed you to the papers that you can look at and familiarize yourself with how these numbers came up. So I'm completely transparent in this, right? So the point is, if you looked at any country, this is how you'd value it. There are other metrics that I think are farther away that I didn't raise. But I think the point here is that these ones and others are all point in the same direction, that we have adequate reserves. The question is, adequacy of reserves? Yes. The answer is, without a doubt, yes. Now, when somebody talks about naked shilling, it seems to me that what he or she has in mind is that we need to defend the shilling in particular ways, right? That is the sense I think I get. Now, I would say we do it in two ways. One is the policy. And this I have explained again and again what our policy is. Our policy is we have a flexible exchange rate regime. A flexible exchange rate regime. We do not target a rate. We do not target a direction. So if you ask me, the shilling has strengthened to X or has weakened to Y, what are your views? My views are, Bob, I have no views. The point is, the only time we intervene is to minimize the volatility. And what is clear is that volatility can actually be destabilizing in the financial sector and indeed in the economy. That is well documented. So our policy is very clear, flexible exchange rate, but we intervene to minimize volatility. So we'll minimize the volatility, for instance, when it is depreciating quickly. Then we will sell some US dollars in order to minimize the speed of depreciation. Or if it is strengthening, and we buy in order to minimize the pace or to reduce the pace of strengthening. As a matter of fact, we've been buying, and you know that. So I just want to make the point that nakedness in this context means that we have no reserves You are thinking of a completely different economy. And I would want to challenge those that made that statement economically. Because you are thinking of a fixed exchange rate. And you are thinking of defending a fixed exchange rate or defending a specific number, a specific target. So that's why if you don't have the firepower, then you're in trouble, right? And that's the nakedness in this case. It's worse when you begin to think that we have been making this point for quite some time. Not only here and elsewhere, we've also been making it in the market. So if you don't believe what we say, at least look and see at the track record. Look at and see what the track record reveals, because the track record is completely consistent with this. Frankly, also, talk to any person out there on the street. They really appreciate the policy that we have been following in terms of the outcomes, and indeed in the way we've been doing it. Remember, we could not have done this if we didn't have a strong macro framework. So it isn't just thinking that you have one policy and it will speak by itself. It's actually supported by other very strong policies elsewhere. Credibility of the monetary policy and credibility in terms of the objectives and so forth. So I hope I've explained myself in this, and I would really urge you, when they make those statements, challenge them. What exactly do they mean by the naked shilling? Because it may mean 300 things to different people. And I think that's the issue, right? You paint a picture, they paint a picture and then they leave it to you to sort of understand. I do that occasionally, by the way. I did it a moment ago, if you noticed. Not about this, about other statements. Let's leave that for now, right? But let me now take the issues in terms of the differences. Kabui, I hope I explained the stability issue in the context of what is our exchange rate policy. So let's be clear, flexible exchange rate regime, and the only thing we do is to intervene to minimize the volatility. And that is quite standard and quite well understood in appropriate circles. In terms of Keva's fear that we are going to go to $100 per barrel, so the sky has fallen on your head, that's what you're saying, right? Okay, let's deal with it when it gets to that. My point is, I say that with a pinch of salt, because that you can have horrendous outcomes. If we were having coffee on the 23rd of June in 2016, and we talked about Brexit, I'm sure both of us would have said, never happen. It will never happen. And all of us said that, right? But then on the 24th, boom, we get a... So I'm just making the... And in terms of oil, price of oil, nobody can predict these things. Actually, if there is something that is very difficult to project, is the price of oil. It's true we use futures and things like that, but there is too many... There are vagaries in there that are beyond our comprehension or our models and things like that. So yeah, sure, things like this would happen, but if the price went that high, there are many things that would need to take place. It isn't just, you wouldn't be worried just about inflation. I think we are rather young to worry about to remember what happened in 1973, was it, Terry? Professor Ryan? You are still teaching, if I recall. The point is that when there was a surge in the price of oil, and that actually sent the world into a tailspin in terms of recession and all those other things. So at that point, you're no longer just worried about inflation. There are many other problems that come with it, right? It's a bit like the global financial crisis. The global financial crisis wasn't just saving Lehman. There are many other things that happened, and frankly, we started, or that whole process, it started processes that we didn't know where they're going to end. So I hope I've answered your question, right? But we need to be clear. Somebody, I think it is Victor, I don't know if it was Victor or Keva who asked the question, well, don't you take insurance before you drive and all that? Well, there's a difference. meaning you are required to drive, you are required to have insurance, right? But this is a question of, I mean, are you going to take insurance on it's an option that you have. And you have to figure out whether it is appropriate given the risks. And the program isn't just about that. There are many other things. Our relationship with the IMF isn't just a program relationship, and I hope you appreciate that. We are worthy members of the IMF. By the way, this is something also that you need to appreciate. Please look at that little paragraph that some of you have been circulating from the Eurobond prospectus, right? You know what I'm talking about. All of you, I'm sure, know what I'm talking about. And look at it because it talks about other things. And I think there has been articles that kind of misunderstood or misread that article. It talks about no longer being eligible to the resources of the fund, right? And that whole business, I think you understand what I'm saying. Those are the issues that need to be flagged about not being a member of the IMF or not having access to the upper credit tranche resources of the fund. Those issues are completely different from the ones we are dealing with today. We are worthy members of the IMF. And by the way, it's true, I've worked there for 20 years, so I think I know what I'm talking about. Then Alex asked about the 41% of remittances. And the issue there, Alex, a lot of this is really through the banking system. So there may be other things, for instance, through informal channels, right? But I think the point here is that already through the formal channels, you've seen an increase of 41%. That is significant. And I think that is something that we need to appreciate more. Where are these investments or these diaspora payments going to? I think in the usual places. First, of course, they're going to the families. People are building. The number one investment by the diaspora is building, construction. And you have your 100 by 50, or you are building your mother a place, or you are building your palatial home, whatever it is, I mean, the entire gamut. But there are other things, when there are problems in the family, people send in. So it is that whole, let's say, social safety network that we are familiar with. There was a question about excise taxes and the impact on this. As always, one can expect any tax will slow the process down. I hope. So, as we understand it, the Financial Act has increases the excise tax from 10 to 20%, right, on these flows. And it gets rid of other proposals that were there before. But the point, of course, is that there'll be a reduction, just like any excise tax. Right? If you have a tax on something, you will generally have a reduction in the transmission or that value, or whatever it is, the underlying value. So that is expected. But I think the point here is that it is important for us to go into other forms of taxation or to expand the effectiveness of the tax system that we talked about. Maybe I should make the point that one of the issues from FY 17-18, the last year that ended, is the reduction in effectiveness of tax collection, right? And this is something that obviously National Treasury is working with KRA. The tax collection, the tax intake as a percentage of GDP fell quite sharply, and that is a source of concern. So I don't want to just look at one tax in isolation, because it has to be. There has to be revenues that are raised to deal with certain expenditures. But I think the point you're making is that some of this may be a bit inefficient compared to others. And the point is well taken, of course. I hope I've answered your question. Okay.
Any last ones? So now in Toronto. So Adelaide is on the that has asked a question. Anyone else? For the 2 rounds. That's to 3 people. Please remember to keep it as succinct as possible. Starting with Adelaide.
Hello, my name is Njoroge. I'm from Bloomberg. Thank you for reading our stories. I have two questions. The first is on the one word you've consistently used since I think you came to the central bank is accommodating monetary policy and room for a more accommodative stance. And I'm curious, you haven't really mentioned that today. Do you still see room for a more accommodative stance as you have been saying previously? And also on the fiscal deficit target, the National Treasury revised that up to 6% last week. And I'm curious, given the fact that you linked this to making monetary policy more accommodative, is that a concern, 6% versus the 5.7%? Will it slow down? Will it have any impact? So, thank you.
My question is about the LRU and the printing of new currencies. Could you give us
that again?
The LRU and the printing of new currencies. So could you give us an update on where we are so far? Thank you.
Finally.
Yeah, the question is personally, you talked about Fed caps strangling the economy.
Yes.
But you still maintain that you see the economy is growing at 6.2%.
Yes.
Do you sort of see an economy where the 6.2% will make sense to a lesser population as compared to maybe the 4.9% of last year as a result of this rate cap? And then second one is on IMF. Yes, you painted a rosy picture on how comfortable we are with the results. So does that settle the topic that maybe you'll not be having any future discussions with IMF concerning this arrangement?
I wasn't trying to paint a rosy picture. I was just trying to present the facts. You paint the picture you want. So I want to be absolutely clear. If I wanted to paint a picture, I would have painted it. Here I was trying to, actually I thought it was very dry, what I was presenting to you. So you deal with it because it's you, not me. I want to stick to the data, and the data are there. I gave you specific numbers, specific indicators. It's for you to paint whatever picture you want based on this. If you deviate from this, then we can have a conversation, right? So I'm sorry if it seemed like I was painting a picture, then I think I didn't do a good job. So I apologize to you. But let's move on. The question, though, which is still valid, your question is, will we sort of have an engagement with the fund? And I thought I tried to explain that. That is the part probably that fell apart. Meaning, sure, we do have a specific relationship with them as well. Starting from, there are many levels of engagement. I mean, to begin with, we are worthy members. And this is what I was saying. And we have surveillance. They do surveillance with us. And we have discussions about economic policy in the context of Article 4 consultations and all those other things. So there's a very, let's say, dynamic relationship that you cannot just walk away from, if you see what I mean. And it will have benefit as a country. Here you have people that can engage with us on economic policy, and they're probably bringing experience from other parts of the world. So I didn't want in any way to insinuate that there's a sort of divorce, as was prominently indicated in some of your cartoons. By the way, I read articles, I read cartoons, I read anything I can lay my hands on. So if you want me to read anything, put it in front of me. Okay, so there is that engagement. I hope I'm clear about that. And we want to continue with those engagements. Whether it will lead to another precautionary arrangement and all those things, that is for later. That's not the issue for now. The issue now is, yes, we have some things we need to do. And I think I've already mentioned some of the things that we ourselves intend to do. I explained in a fair amount of detail to Omar what we want to do on the rates cap thing. And on the specific points, you can actually see we have them out there. We even have them on our website. So you can confirm what we are doing. There's no feeling that we are under somebody else's control or any of those things, okay? Mind you, the issue of independence is important. Independence of the central bank, even from other actors. That I would let you paint whatever picture you want. I hope you're okay. Okay. Then the issue about the 6.2. You are right that if indeed, in the absence of this drag of the economy, and the drag here is the rates cap, the economy would be doing much better, much better. So the 6.2 would be much higher, right? We won't be saying, but I don't think the issue for me is just growth. The issue for us is not just growth. It is important for us to have much more inclusive growth. The word is inclusive growth. So if we agree on more inclusive growth, higher and more inclusive growth, then we are, I think, in the right quadrant. It cannot just be, famously, you have said the thing, you cannot eat GDP, right? That's what, that has, I hope you're not going to quote me on that one, But I think you can see what I'm getting at. The issue is inclusive growth. And if you have people that are struggling in the SMEs, you talked about SMEs, you have people who are trying to start, they need 50K, and the only place they can get the 50K, my butcher, for instance, okay? My butcher, or even for that matter, my barber, I don't know, they have discussions with me about these issues, right? He wants to expand his facility. And he tells me that he's going to employ, I don't know how many people more, right? But he cannot get appropriate funding. He needs to buy a new chair or however many chairs and all those other things. But he cannot get that from his own, let's say, revenues. He cannot build that. He needs that capital right away. I'm just making the simple point that if we actually look the other way in terms of him not getting capital or going to some Shylock to get capital at X amount. And the Shylock, by the way, could be one of these mobile lenders, that are now all over the place. My point here is that then we've lost our business, we've lost our way. Because it's our job as policymakers to protect even those ones, not just the GDP, large GDP thing. I mean, the barber is in the services sector. And he's small, but he is actually doing serious economic business. And that's the issue. And those are the stories that need to come out. Talk about the Mama Mboga in the market just down here, Wakulima Market, who is doing all these operations and all that at 3 o'clock in the morning. Those are the people that actually cannot get the funds that they need. And she wants to move from, a kiosk this big to, 3 stores where she employs 1 person, whatever it is. So I think these are the issues that we are dealing with. And I am sorry if I'm passionate about this, but maybe I shouldn't apologize for being passionate about this. Deraru printing currencies, the matter, as you know, is before the courts. A ruling will be soon, and we hope that the ruling will allow us to move ahead with printing of new currencies. And so we intend to we hope that that is what will come out so that we can move on this business, which is long delayed. Accommodative monetary policies, yes. I think the point I wanted to make, and this was laid out in the press release. By the way, I do read Bloomberg, but my favorite is Mohamed El-Erian. So, and precisely on the EMs, please read him. Maybe you should read Bloomberg. There's a whole story of the EMs, what's happening in the EMs. And I think a lot of your articles in some of the things I'm reading get it wrong. There's a lot more going on in the EMs. I say this also because we're anticipating, we've done some work on this, we're anticipating, sorry I deviate, but in a few weeks we'll be attending the annual IMF World Bank meeting. And one of the big things that will be on the table is what is happening in the EMs and what is the, let's say, the fallout on and the contagion in other markets. So anyway, I'll leave that. In terms of Kenya, our accommodative monetary policy, I think the point I would make here is that the press statement did not raise the issue of accommodative monetary policy. And I think it was for the following, it dealt with that issue, the underlying concern, in a different way. The first thing was the concerns about inflation. And I think it was interesting even when I started off, that my first statement was the concerns that linger. So that is a big concern, and that is our number one concern. And secondly, the other issues that come up in terms of whether policy, we are getting perverse reactions to policy. That still remains. And we have done additional work. I didn't want to belabor you, lengthening the press conference, but we've done additional work which shows that actually, yes, there is actually some perverse reactions that are already taking place. So that's why that issue was overtaken by those other concerns. 6% fiscal. I think the point I would make here is that there is talking about just this year, it's 5.7. But I think the point I would make is if things change, we can accommodate it. The issue for me isn't so much the target, frankly. It isn't the target. I mentioned the target and quickly talked about implementation. I think we should appreciate that. It is really the outcomes that are more important, not just the target. In the past, we had nice targets, but somehow we lost our way in the course of the year and things like that. Last year, the outcome was good in terms of the deficit. I talked about that. But I also made the point that the details above, meaning on the revenues and expenditures, were a concern. And I think the National Treasury officials are working and dealing with those issues. So I think it's a package. We cannot just pick one number and say the matter is dealt with.